So let me just get started and climate finance and the carbon markets. A really interesting background, and if you don't mind, I'll kind of highlight some of the points that are interesting to me. But I'd love to hear your story as well, and how you got to this space. I mean, you've been a career finance guy, and including some pretty impressive institutions. Starting with a educational background, including an MBA at University of Texas, and of course in India, an undergraduate degree, and then going through sort of the big names in global finance. Deutsche Bank, Goldman Sachs, Merrill Lynch, Enron, Price Waterhouse. This is a kind of a you've got the resume that's quite remarkable, and you come and it really, I mean, some pretty diverse experiences too, right? A lot of work in the natural resources sector, a lot of work on in terms of structured finance and credit and utility stuff. So it's pretty diverse background, even in the finance sector. Tell us a little bit about that career and how you came to where you are.
Sure, and thank you for that introduction. So it all started with 1996. I finished my chartered accountancy, which is the equivalent of the American CPA, but we follow the English system in India. And I come from a fairly traditional family. So once I finished my exams, then my parents' view was that the only thing now left to do is get married and have kids. That was it, right? You've done through your education. So that's the next goal you need to achieve. And I was too young, too jaded at that point in time, and I didn't want to get married. So fortunately, I worked for a company called Enron Oil and Gas in India. I was their auditor while at Price Waterhouse, and the gentleman there, the chief accountant, I became good friends, and he came up with a brilliant idea that, Milind, run away from home, go to the US, get an MBA, you'll delay everything by 2 years, and that's it. And then we'll see what happens in 2 years' time. The only small problem I had was my sister and I both wanted to leave to go study abroad. And Dad said, I can pay for one of you, not both of you. So fortunately, this gentleman offered to underwrite my education. And that's how I ended up in the US. Little did I know that I would finish my MBA and join Enron. I'm not sure how young your class is, but most of the people probably haven't heard of that company. So this was a very, very large energy company. It started off as a combination of two large pipelines, gas pipelines in the US. And they literally invented the financial and physical natural gas trading market in the US in the mid-90s. And when I joined them in 99, they were at their peak almost at their peak in terms of their business, the development of the underlying markets, and their position in the energy sector. Unfortunately, they got too big and they got too greedy, and they made some bad decisions and ultimately leverage and brought them down. So that's where I got my spurs, or to speak, in terms of the energy business and how to do structured finance transactions. They were way ahead of their times, and pretty much all of Wall Street was vying to do business with Enron in the energy sector at that point in time. From there, I left Enron, started a small boutique investment bank with a few colleagues from Enron. Unfortunately, we got caught in the 2001 recession in the US. The venture failed. And I went worked with an insurance company, and then eventually worked at Deutsche Bank joined them in 2004. All along, I'd been doing structured finance transactions with energy companies and metal producing companies. So my background, because of my accounting background, that gave me a little bit of an edge in terms of understanding finance and the implications of doing structured deals and how that would show up on the company's financials. And that got me started with the finance business, essentially. 2007, again, for not where, my parents lived in Mumbai and I needed to be close to them. So that got me to Singapore. Little did I know there was a financial crisis brewing. I avoided that bullet and reached Singapore before the world kind of blew up. But then I worked at Merrill in Singapore, again, in the commodity sector, doing structured finance. Post Merrill, then went back to Deutsche Bank, and then eventually joined Goldman Sachs in Singapore. Again, and most of my work has been lending money to energy companies, metal producing companies, and then doing derivatives, risk management in the energy sector. That went on till about 2020, 2021. Eventually, I was part of Goldman's investment banking team. The center of gravity for the Asia business for Goldman is Hong Kong. And, they essentially asked me to move to Hong Kong. But my family was so well settled here in Singapore, and it is very well settled, that I declined to move to Hong Kong, and we kind of parted ways from Goldman. Unfortunately, at that point in time, I had some friends at Shell. This opportunity came up where they were looking for people with investing background to come and join the carbon business. And I figured, this is a good way to pay for my past sins of the last 20 decades of working in the commodity sector and helping oil and gas companies grow. And I said, okay, it's come full circle. I'm going back to my roots, joining an oil company, but this time on the carbon side of things. And so what I do at Shell is essentially look for projects where we can invest Shell's capital, Shell's cash, in exchange for getting access to carbon offsets. Excuse me. Charles, how familiar is the class with the concept of carbon offsets, and how much deeper should I?
Yeah, okay. No, they were pretty well down the track. We've covered voluntary markets, compliance markets. We're just starting today and next week. We're jumping sort of deeper into the project side itself. So, sure. In fact, and that's really why when we talked this afternoon, I thought, this is somebody who could really add some value to this conversation, because your role as a on the commodity side and financing companies to extract natural resources, or to to finance infrastructure for energy. That's really that's a very advanced side of the finance world, right? There's a lot of money in it. There's a lot of effort to be efficient as possible, to set up mechanisms to manage risk, and none of that really exists yet in the carbon world. And so it's really interesting to hear from you on that front, but also your mandate really and remit with Shell to go out and invest in actual projects, and how you guys think about that. These are the things I think that would be really interesting for the class.
Sure. And so, coming to Shell, essentially the biggest change for me from a banking world, for example, was Shell's willingness to take market risk. So when I did these financing transactions at banks, what we would try to do is essentially earn arbitrage profits. And what I mean by that is we would try and lend money to a company, but then try and hedge out as many risks as possible by mitigating exposure to market risk, sell down the credit risk by, mitigate credit risk by selling down the financing to commercial banks, mitigate interest rate risk by doing interest rate derivatives and locking in cost of money. And so really what you're left with is effectively fee income and some counterparty risk for underwriting the transaction. When I came to Shell is a operating company, and they get paid by or rather, their shareholders want them to take market risk. So if you think about how nascent the voluntary carbon market is, we are doing projects where we'll provide capital and we will fund transactions where we will agree to buy carbon offsets at a fixed price for 12 years, 15 years, 20 years. And if you think about what happened to the carbon market in 2021, for example, one of the first deals we did, I wasn't there at Shell yet, but what Shell executed in April, and I'll walk you through a specific project. We funded a project that distributes energy efficient cook stoves in rural Africa. And the theory there is that currently these households are using firewood on open pit fires, put 3 stones together, put the wood in the middle of the stone, light the wood to fire, and then use that fire for cooking, boiling water, and other household uses.
This one.
Now, yeah, okay. So this was the second deal that we had done and we announced. But so what our partners here, Sequest Capital, have done, they have developed a cook stove which reduces the amount of firewood that is consumed to produce the same amount of energy. And by doing so, that effectively reduces the amount of wood that is consumed by these households, and hence results into lower emissions, but also a lower deforestation and effectively chopping down of trees to produce firewood for household uses. The other big benefit here is also, as the wood burns a lot more efficiently, there's a lot less smoke generated in the household, which then reduces the ill effects of inhaling smoke and helps improve the lives of the people who benefit from receiving these kind of cook stoves. So if you think about this, the value of these cook stove credits, and so clearly as you're distributing these cook stoves, there's no economic value. Nobody's going to pay you for distributing these cook stoves. And so these projects then meet the key additionality criteria required for a project to be eligible for carbon financing, right? And so as carbon credits get issued, these carbon credits in early 2021 were worth roughly around $3 a ton of carbon equivalent. That's when we financed these projects. And by the time we did the second transaction, we started talking about the second transaction in Q3 2021, negotiated terms in Q4 2021, and closed in January 22. The price of these cook stove-based carbon credits had almost gone up 3x. Now, you can imagine that if in a given year, a price can change from $3 to $8, $9, $10, Shell is now committing to buying these credits over a 12-year period. The world can change in 12 years, right? And to have that kind of risk appetite to be able to commit to a price for 12 years to a product is something that I'm still coming to grips with, compared to, given my training and experience and thought process at a bank of how do I get rid of market risk and create an arbitrage profit, to now how do I add market risk so that I can make a lot more money over a 12-year period. So that's a big change for me in terms of how we look at things here at Shell. So what makes us comfortable and what gives us the ability to be able to take a 12-year view on commodity prices? Now, if you think about Shell's primary business or core business, which hopefully over a period of time will evolve, is producing oil and gas, right? And there is no way we can bring the carbon emission for oil and gas to zero. Effectively, we are producing carbon from the ground and then selling it for people to consume energy and for their purposes. And so we know that over the next 10, 12 years, we have a very, very good view as a firm on what the oil and gas demand is going to look like over the next few decades. Given our view on demand for oil and gas, the only way we can offset, one of the key ways we can offset our carbon footprint from the sale of oil and gas is to invest money in projects that generate these carbon offsets, right? So while we can't go to a complete zero value in terms of the carbon content in the oil and gas we produce, we can offset those by investing in projects that result in a reduction in carbon somewhere else. Now, because we have such a long-term view on our oil and gas business, we are also able to take a very long-term view on what the carbon offset market might look like, because we have a natural short. And that puts us at a very, very advantageous position to be able to aggressively chase these projects and be able to commit capital to projects that produce carbon offsets and take a view which some of our competitors, pure commodity trade houses, they don't have the strength of the balance sheet that Shell has, and they unfortunately will not be able to take a 10, 12-year view to carbon prices. So that puts us in a fairly advantaged position.
It seems like, just from the outside, that it's not very, it's a pretty similar business to what Shell's already in, right? You're out hunting carbon. In this case, right. It's above ground, and you're trying to find the right places where it's happening and most efficient ways of getting it and producing, carbon reductions. Whereas, with the oil and gas side, you're hunting it under the ground and trying to figure out the same way. So it's a similar business, just kind of the flip side of it, I guess. Is that fair?
That's right. And so the big difference is, when you look at, going back to my banking experience, when my client base used to be large oil and gas companies, metal producing companies, and so pretty much everything was in the very organized sector of commerce. Whereas when you look at the carbon world, people who are really successful at this business are generally people who are extremely passionate about nature and conservation. And so, many a times we'll come across people where they will be very passionate about their project, but may not have the same financial rigor and discipline as you would find in a large organized corporate.
Right.
And so, I kind of draw parallels to the wildcatting risk that used to exist in the oil and gas business. You're searching, you're doing exploration for oil and gas, and you're a little bit blind because you got to guess what's there underground, and you have tools to figure out, and you apply probabilities on figuring out what's the probability that I'll hit oil and gas in the ground when I drill a exploratory well in this particular region. So our hunt for carbon projects is something similar, not exactly the same, but trying to find projects where you have confidence that the developer you're working with is passionate, understands the science behind whatever sequestration or carbon reduction project that they are developing. B, also making sure that because we're going to commit to 10, 12 years of project life, what changes could happen in technology, what changes could happen in regulation, what changes could happen in a particular country that could create risks for the project. Because, we're making an investment assuming a certain payback profile and a certain carbon credit generation profile. But if things change, how would we de-risk ourselves, or what is the downside? And so there is that similar mentality of being careful, being prudent about trying to protect your investment while you're doing exploration for the right type of carbon projects to add to your portfolio.
And there's all sorts of risks, obviously, and across political and project type and methodology and counterparty. But those things are all have to be factored into that. One of the things I wanted to make sure we touched on, which is a little bit tangential to the project side, and I want to get back to projects pretty quickly, is why is Shell doing this? Why, looking at it as a business, of course, and selling buying and selling and trading credits like you do energy. But on the offset side of it, what's driving the commitment to offset your carbon? Where's that?
Yeah. So, the buying and selling activity is ancillary to our primary objective. Our primary objective is to help Shell procure these carbon offsets. And ultimately, we are bundling carbon offsets with the energy products that we are selling. So, for example, if you are in Europe and you buy this premium gasoline to fill up in your car, and called V Power is a brand name, those gasoline volumes come with attached carbon offsets. So the consumer is then buying a carbon neutral gasoline product in the market. They want to offset their carbon footprint. So a lot of the offsets that we are buying ultimately are getting used by our individual businesses, like folks providing aviation fuel to the airlines, people selling gasoline and diesel to the transport sector, our chemicals business providing chemicals to the plastics industry. Consumers in these industries are wanting to buy carbon neutral raw materials. And so what we are doing is because, ultimately gas has carbon energy, which produces the energy that is being used. We are bundling these credits with our products and selling them to our customers so that we can help them manage their own carbon footprint in terms of their scope 1 and scope 2 emissions for the products that they're buying from Shell. So, I would say today, if I hazard a guess, almost 85 to 90% of our business is to invest in projects, secure long-term supply of carbon offtakes or supply carbon credits, ultimately to be able to bundle them and sell along with the energy products that Shell sells to its customers. And so that is what is driving our business primarily.
And then swinging back to the projects, are you looking for a diverse portfolio of types and jurisdictions and developers and the like? Or are you looking? Do you have are you focused on particular types of credits? How are you choosing?
So, carbon market, while it is similar to the commodities markets, has one very, very big difference from how, traditional commodity markets operate. Ultimately, this is a voluntary market and depends on voluntary demand for this product. I'm ignoring the compliance market where there's regulatory requirements. And it's also a very regulation-driven market on the other hand, right? So ultimately, the risk that regulation changes or these agencies that issue these carbon offsets, they change the methodologies that are applied and that generate carbon credits, and the units of carbon credits that get generated upon sequestration of a ton of carbon. All of those changes are almost impossible to mitigate in a given project. There are also risks of exports and nationalization of projects because each country is coming up with their own nationally determined contribution to reducing carbon emissions. And so there are risks that countries might change the regulations that might apply to projects that they are currently executing in some of these countries. And so the only way we can mitigate that exposure is through diversification. And we diversify our portfolio through a variety of parameters. As you alluded to, Charles, it's developer types, project methodology types, countries, project types. So, the broad categories are nature-based solutions and non-nature-based solutions. Within the non-nature-based solutions, our focus has been primarily on household devices and projects that have a significant amount of co-benefits because ultimately, consumers have a choice as they're buying these carbon neutral products from us. They decide to choose what type of projects they want the carbon offsets to come from. And hence, to be able to meet their requirements, we need to be selective about the types of projects we end up investing in. To give you an example, and we get into details on projects. So in the early 2000s, under the CDM era, which is precursor to the current gold standard and Vera era, as I call it, there used to be a lot of renewable projects that were getting funded because at that point in time, the cost of renewable energy was significantly higher than cost of power produced from traditional sources like coal, oil, and natural gas. But as over time, renewables have the cost of generating renewable power has come down. A lot of the agencies that issue these carbon offsets have now come up with a policy where large scale projects in developed countries they're not eligible for carbon financing because the projects can stand on their own and they're able to raise financing on their own. So these types of risks, as you're seeing that the project types are evolving, we need to keep in mind as we find new projects that we invest in, keeping in mind that there is a risk that methodology changes or technology changes, which might then reduce the attractiveness of some of the projects that we invest in. Another example would be the countries where some of these projects get developed. For example, cook stoves have become very, very popular as a project type amongst the buyers of carbon offsets. But there is a distinction where, if you have a least developed country, so for example, a cook stove project in Zambia today will be valued a lot more than a cook stove project in India, for example. And the rationale there again is the impact that you would have on a family in Zambia or Zimbabwe, where you deploy these projects. You're going to have a proportionately much greater impact on the lives of people who then end up using these cook stoves than a household in India, where the country as a country, they are a much more developed country than say Zimbabwe or Mozambique for that example, right? And so that creates a differential in the valuation of these credits and the demand for these credits from our customers. So so all of these factors they contribute as we think about diversification, as we think about what kind of a portfolio we want to build over the next decade for ourselves in carbon offsets.
Gotcha. So I know you also invest in avoided deforestation projects and reforestation projects. Is that what do you find in terms of particular issues there that you need to manage around?
So, in terms of let's talk about deforestation projects, avoidance of deforestation. I think the biggest challenge there is meeting the additionality test and making the case that, look, if this project is not subject to carbon financing, the forest will actually get destroyed because it will generate either income for somebody through the selling of the timber, or it's being cleared to create farmland or some other alternative use that would generate income. The biggest challenge you find there is because the capital expenditure required for something like that is very, very small, you get bogus claims where you have an existing forest that exists and people will make up claims that, look, we need to get paid to avoid cutting down these trees. Those trees were probably never going to be cut down. And, how do you figure that these trees will be cut down or will not be cut down? You actually go to site and you have consultants or advisors who help you with this, but you go to the site and you realize that, there are no communities in a 100-mile radius of that forest land. There are no roads in that forest land. There is no way to access that forest land. And for then somebody to make a claim that, look, this forest is going to get cut down if it's not subject to a carbon financing, that claim starts looking a little weak in terms of meeting the additionality test. So it's those types of claims where, you need to be careful about when you're looking at avoidance of deforestation type projects. In terms of reforestation projects, I think the biggest challenge there is estimating, what is the baseline emission currently present, what kind of trees are going to get planted, what will be the reduction in emissions as these trees grow. And the biggest challenge is figuring out how do you avoid accidents from happening, right? So forest fires. So you've planted the trees. Trees take about 7-8 years to get to a point where you're going through an exponential growth in the volume of credits being generated as the tree is growing, and then eventually you get to steady state. And just when you get to that level, suddenly there's a massive forest fire and your trees are destroyed, right? So that kind of that is one of the biggest risks that you run into in terms of risks to these projects. A lot of the countries where these projects are being developed, the land actually belongs to the government. And, these governments have announced nationally determined contributions. They have their own quotas to meet. And, a classic case is Indonesia, right? So a couple of weeks ago, they just announced that they will stop issuance of carbon offsets for credits for 5 types of projects in Indonesia. And there are certain provinces in Indonesia who will not be able to issue offshore credits because Indonesia feels that if they don't protect some of these forest lands for themselves, they will not be able to meet their own NDC targets they've laid out to the world. So, how do you avoid that kind of risk? Because, again, the land belongs to the country. Some developer is leasing the land. Lease gets canceled and suddenly you lose all your credits. So the way we think about mitigating those types of risks are we look at what is likely to be the domestic demand for credits from that particular country. So if for whatever reason we are forced not to be able to export credits from that particular country, then is there a possibility that the country has a domestic compliance scheme or there's voluntary demand within that country, and then we can sell those credits to consumers in that country? So fortunately, again, Shell's retail business is very helpful. Most of these countries will have retail distribution of energy products. And so, that becomes one of our plan B or C in terms of developing projects where if for whatever reason we're not able to export the credits, then at least we have a domestic market where we can sell these projects. I got a question on the chat saying what types of projects, which countries yield the highest returns and why. So you have to think about, and this is the beauty of commodity markets, right? On the one hand, 1 ton of carbon saved is 1 ton of carbon saved. Doesn't matter how you save it and where that savings come from, what kind of projects, right? That's what you would imagine. But unfortunately, there's a human element here which determines other factors come into play, which then determines the value of a carbon credit. Like I mentioned, a cook stove project in Zimbabwe, we can weave, or there is a very, very good co-benefit story that comes along with it versus a cook stove project in rural India, where the government is trying to distribute, increase the network of electricity distribution across the country. So a Zimbabwe project then trades at a premium to an Indian project simply because people have a greater appeal of the Zimbabwe story versus the India story. Now, assuming there were 2 projects in Zimbabwe or 2 projects in similar countries where the co-benefits are similar, then the value creation is the highest where you can have the least cost of producing a carbon offset. And so that's why you see that today a lot of the projects that are being developed in the quote unquote the global south, whereas the demand for carbon offsets is all coming from the global north, right? So there are, economically weaker sections of societies in the developed world, but the cost of developing a carbon project in the developed world is significantly higher than that of developing it in a developing country. So in countries, you'll see a lot of development work happening in Africa, for example, where that's where a lot of these projects are getting developed. Again, because the cost of development of these projects is the least, and you can have the biggest impact in terms of co-benefits with these projects. What types of projects? I think the nature-based projects are trading at a premium. They generate better value than the non-nature-based projects, simply because when you do reforestation, they're called removal of credits. And today there is a perception that removal of carbon dioxide is more important than avoidance of production of carbon dioxide, because indeed there is a lot of carbon dioxide existing in the atmosphere. And so there's a perception, I'm not making a judgment on whether it's good or bad, but the perception is that 1 ton of removal is better than 1 ton of avoidance of generation of carbon emission. And hence some of these nature-based projects trade at a significant premium to non-nature-based credits. So, and that differential can be almost as much as 35 to 40% in terms of value of credits.
There was an earlier question around, and this, I know that, Shell is famously picky about investing and do a lot of due diligence, and your project selection, sort of, what are your sort of principles or standards or red lines that you don't go beyond, or how do you sort of, what are your sideboards in terms of your investment?
So let's, I think this is a good segue also in terms of giving you an example of how do we go about developing a project, making an investment in a project, right? So this is, a project, Charles, we discussed this afternoon. So we are looking at a project in India where we are going to replace incandescent bulbs, i.e., ICL bulbs, with LED bulbs. And the rationale there is LED bulbs are almost 75 to 80% more efficient in terms of consumption of electricity for the same lumen output as an ICL bulb. And if you look at India's energy grid or composition of supply of energy, 75% of the energy supply generation is coal-fired. So if you can reduce the consumption of energy in India through a energy efficient device, i.e. a LED bulb, you're going to reduce the emissions of carbon in the country. And hence, it's a good thing for the environment. Now, 2 questions. Well, if you are going to reduce the consumption of energy, how are you going to meet the additionality test in a energy efficiency program? So if you're a commercial enterprise and you say, okay, I'm going to replace my ICL bulb with an LED bulb, the LED bulb costs almost 7 to 8 times as much as an ICL bulb costs. So there's a higher capital expenditure upfront. But I'm going to produce a significant amount of savings in my energy cost over a period of time. And so those savings should be able to pay for my capital cost. And hence, I don't need carbon financing to encourage people to do this. Now, that may be true of commercial enterprises, but does the same logic hold for a rural household that has 5 kids, lives and the family is a daily wage earning family? So they don't have monthly salaries. They don't have certainty of income. If they don't work in a given day, they don't earn any money. And average income for these people is roughly $2 per day, right? One of these energy efficient LED bulbs costs about $1.25. Now they have electricity supply in their house. They're buying a bulb that costs about 15 cents, 20 cents. For them to switch over from a 20-cent bulb to $1.25 is a very, very tall order, because that's roughly around 60% of their one day's wage. And if you think about these families, there's enough that, and if all of you probably know, the number of mobile phones and access to the internet has grown exponentially in India. All of these families are spending a lot of money on healthcare and on education so that they can pull their families out of poverty and their children can have a much better life. So they would rather spend their income on healthcare and education than on bulbs. The other reason they don't spend money on bulbs is the supply of electricity in India is very erratic. And because of fluctuations in electric supply, these bulbs fuse and they blow off. So you spend $1.25 on a bulb, within a week your bulb blows off. You've incurred a pretty hefty loss compared to spending 15 cents on a bulb. So these are the types of analysis we'll do, whether, even though a commercial enterprise will also generate savings, but it will fail the additionality test from a Shell diligence perspective and a standards and principles perspective versus a rural household. So we will invest money in a project that will only distribute bulbs in rural households, or will not do this in urban centers or in commercial enterprises. And so, these, give you another example, renewable power, right? So while Vera will issue credits for any project less than 200 megawatts in a least developed country, Shell will only buy credits off of projects that are 50 megawatts or smaller, because even at 200 megawatts, there's enough commercial financing available for these projects. We, on light bulbs, the amount of diligence that we will do in terms of, I'm actually going to India in May, traveling to actually doing everything, plane, boat, and a car ride to go to the actual villages and the districts where we're going to end up distributing these bulbs, to actually meet with these people, make sure that they are not being coerced into doing this because there's somebody trying to make some money off of distributing bulbs and taking advantage of these communities and of their needs. We're doing a fair bit of work in terms of figuring out how are they going to monitor these projects, right? We are going to distribute millions of bulbs over a 3-year period. How are you going to ensure that the household receives this bulb? Next thing, they turn around, they take the bulb, sell it in the market for 60 cents and buy 4 incandescent bulbs in their house. How are we going to avoid that, right? So what we're going to do is, we're going to stamp these bulbs, not for sale, put logos on them, make them as difficult to resell these bulbs as possible. The other thing we do is, as these bulbs get distributed, we make sure that we exchange a bulb for an incandescent bulb. And so we take away the old bulbs and we actually crush them, we break them so that they don't get reused. These are things that ultimately add to the overall distribution costs that we will end up incurring in this project. But so be it, right? Because what it does is it translates into a project with significantly better integrity, and hence will trade at a premium to another light bulb distributor who doesn't have the same care and diligence on their project. And then we are able to command a premium for some of these projects and some of the credits that get generated. And, let's face it, as a big oil company, we are always in the spotlight. So, while you're trying to do good, you don't want to be caught with your hand in the cookie jar, trying to cut corners and make some money off of trying to do something good.
Now, one thing you kind of raised indirectly there is this kind of problem of monitoring and evaluation and the ongoing, ensuring that what the project has said it will do is actually happening. How much of that, you've obviously made some investments up front in these kind of projects, help to design the projects. How much do you actually get involved in the down the road? I mean, obviously you've got a verifying body that's going out there whenever there's a credit to be issued, saying, "Yep, they did what they said," and they're doing the monitoring. But how much do you get? Do you do more than that as Shell?
Actually, quite a bit more. So, for example, the Cookstow project that you referenced, to give you a little bit of color, we actually get quarterly reports. The way we set that up, we typically will do, developers will develop projects for Shell. there'll be a pre-identified set of cook stores that will get distributed. And there are quarterly meetings with the developer in terms of ensuring actual deployment is happening the way it's happening. We get access to the developers' IT systems, where they are getting reports from their implementation partners and people who are doing the monitoring. So, for example, if you run mathematically, the actual monitoring sample size that is required for issuance of credits is a very, very small percentage of the total population of devices distributed. But we end up incurring additional cost in terms of hiring people who are actually going to go door to door and cover a significantly larger sample of cook stores to make sure that these cook stores continue to be in use so that we are able to claim the credits. So, for example, monitoring, reporting, and verification may require 1x of volume to be sampled. Our programs require almost 5 to 7x actual monitoring being done. And as that information is feeding back to the developer, our asset management team and deal management team has access to the systems, and they're doing their independent checks to confirm that the results are flowing in through from the implementation partner to the developer, and we're monitoring the results. Now, eventually the hope is that there will be some kind of a RFID tag or some kind of a QR code being attached to some of these devices, and this information is getting uploaded onto the cloud, and we are getting real-time information in terms of the use, but we're not there yet. And I think we're getting there. A very interesting question. What kind of projects do you think are most valuable to society? I think that becomes a little bit of a judgment call. And what I'm going to tell you is Milind's opinion, not Shell's opinion. Look, I think, like, for example, one might say that if somebody has electricity in their house, do they really, really need carbon financing to buy an electricity bulb that costs, $1.25? Can they not afford it? The way I think about it, compared to a cook stove in Zimbabwe, for example, where, the inhalation of the smoke creates a lot of illnesses amongst young children in the families, parents having to go long distances to gather firewood, not being able to take care of the children while they're doing all these chores. And so as you improve efficiency, these projects ultimately do have a pretty significant impact on the livelihood and the quality of life of these families who benefit from these projects. Coming back to the LED bulb, if my running cost of electricity is going to go down by 75%, I'm going to be able to use that much more electricity. And my kids are going to be able to study that much longer at the night. I'm going to be able to do a lot more things after the sun sets, which otherwise I could not do. And my day can become longer and it can be a lot more efficient with my time. So ultimately, these things do have an impact on the quality of the lives of these individuals involved. Now, is that going to have as big an impact as actual reduction in waste of electricity, waste of consumption of energy? Probably not. But, it's a function of how do you measure success, right? Do you measure it just purely on reduction in per ton of carbon, or do you also measure it in terms of the additional benefit that you're having to the lives of these people? Ultimately, I think renewables are going to become a bigger and bigger proportion of the grid of our supply of power, and that's the direction in which society is moving. But what is really going to have an impact is us becoming a lot more conscious and reducing our consumption. I think that's, to me, that is the real value that we're going to add. But I'm not sure we're all ready to start sacrificing our quality of life for the environment. And I think that's the biggest challenge in my view. Yeah. Aside from overstating deforestation rates mentioned before, what other possible inaccuracies do you look out for in projects? I I think, again, I haven't done a lot of nature-based projects. My focus has been primarily on these household devices. And so to me, I think the biggest challenge is actual reduction in carbon by use of these devices. Like I mentioned, I think there's a real risk that you distribute these LED bulbs. Somebody just turns around and just sells these bulbs in the market at 1/3 the price, takes the cash, replaces it with an ICL bulb. How do you monitor that? How do you manage that? Or cook stoves, right? So I distribute cook stoves. Tomorrow, carbon prices are double. A new developer comes in, goes to the same household and says, hey, get rid of the cook stove that Shell gave you. Here's another cook stove, and I'm going to give you 20 cents for using my cook stove and not using Shell cook stove. Now, how do you protect against that? So it is very similar to overstating the deforestation rates. This is, again, overstating the actual use of these devices and leading to a generation of carbon offsets. Another risk is, if your baselines are measured incorrectly in terms of setting the level from which you're going to measure the reduction in emissions, that itself is a problem, right? If you start off with the wrong data point, then you're going to have wrong results throughout. And you saw that happen in China last year, where a lot of projects had to be kind of redone, where the government realized that measurement of these RED plus projects was incorrect, and a lot of projects had to be restructured, volumes had to be reduced, and so on and so forth.
It's interesting, the development needs of the global South, for the last 60 years since, the global North has kind of tried to understand and how they can aid the development curve in the global South. There's been kind of a bad record, really, in terms of the UN, the aid agencies actually making things happen in the global South. One of the things that's been very attractive to me about the carbon finance world is that the business model is quite a bit different than a government just making an aid grant, right? You have to have in place these monitoring and measurement protocols. You have to have in place the sort of these fail safes for things like substituting bulbs or faking the deforestation rates. I mean, there's really an accountability loop that in a business sense that there isn't really in that government aid sense, and that's one of the things that's been attractive to me about it.
And so this will address the next question that came up: who develop these projects? Actually, NGOs, or are they companies that make money out of them? So again, I have to caveat: this is my view, not Shell's view. I think capitalism as a system is probably one of the best systems compared to the alternatives. It may not be a rather optimal system versus the other systems available. So are there companies that make money? Yes, there are companies that make money. For example, as I said at the beginning of my start my discussion, a lot of these NGOs are very, very passionate about the cause that they are advocating. However, they don't have the financial means to continue to develop these causes and produce results, which is where the financial discipline of capital markets and business come in. And this is what, Charles, you were referring to. If there is that discipline from people who ultimately benefit and generate profits out of these projects come into play, more and more capital will get attracted to finding these solutions and ultimately lead to a much better outcome relative to an aid and a government or a multilateral agency driven model where you're going to have that free rider problem come in, and resources will not be allocated in the most efficient fashion as they would be in a capitalist approach to these projects. For example, as I said, we would go to the projects that have the least cost of production, i.e. least cost to reduce emissions, which leaves more capital available to invest in more projects and ultimately increase the total volume of carbon offsets or carbon reduction that takes place in the world. Is there a big demand for environmental professionals in Shell's investment team? So, actually, very good question. This is a good segue into how are we organized and how we set up across the world. Broadly, there are two teams at Shell. I am part of a team that sits as part of our trading and supply business. So our mandate is to buy and sell credits, make investments from a debt and mezzanine financing perspective. And we take a market's view of the carbon market. There is also another very, very large team that is very similar to our upstream business, i.e. they do exploration. They actually go buy land, they develop land, they study what species of trees they should plant. They do actual development work on the projects. So that team has a lot of environmental specialists because they focus purely on nature-based projects. And it could be, better agricultural practices, soil carbon, forestation type projects. And so they have a fairly large number of technical people who have an environmental sciences background, not necessarily a financial background, who then help with the technical evaluation of these projects. Then there are, folks in my team who will work with them to add in the financial discipline on as we structure these investments and these projects. And I guess we are set up globally. We've got teams in Australia, Shanghai, Singapore, London, and San Diego, and Calgary for our team.
Great. Well, Milind, I don't want to keep you all night. I know it's really generous of you to spend the time and to jump quickly from a meeting this afternoon where we'd first met to an hour with 50 graduate students from Hong Kong this evening. It's really generous for you to do that, and we're very grateful for the time you spent. You've offered really a good kind of sense of color of how the corporate sector thinks about the carbon market, and I think especially Shell, which is probably the biggest corporate player in the carbon market in the world, which is a testament, I think, to how seriously you all take this market and the obligation, I think, ultimately to become carbon neutral. So appreciate your time and your efforts, and thank you for spending the time with us.
Look, and as I said, I was quite humbled and honored to talk to a bunch of students. Hopefully, I've at least created a little bit of further interest in the subject, and hopefully the world will be able to manage further reduction in emissions as more and more people start actually focusing on this particular issue.